In this video, I'm going to teach you how to trade the sweep and shift entry model. Now, there are two things that you need, not in any order, but you need to mark up your key level to target into. Now, key levels are just liquidity points or points in price where you're anticipating the price to ideally gravitate towards once you are in a position. Secondly, you will need to see a liquidity sweep. Remember, an important rule when it comes to liquidity is that penny liquidity should be used as targets, not a bias. 2, liquidity sweeps can influence your anticipated bias. So the moral of the story there is that you will never know when liquidity will be taken 100% of the time, but you can react based on liquidity being swept. So the two main things here is to again mark up your key level and your liquidity sweep. Once a liquidity sweep has occurred, it is better to see a more impulsive shift, taking out previous highs or lows depending on the trend. Now at this point, you should have marked up 3 things, which is your key level, your liquidity sweep, and the shift. After that, you'll want to locate your point of interest. Now this can either be an extreme POI or a breaker. Once you have done that, it is now time to remain patient, sit back and relax, and wait for the price to pull back into your POI. Assuming prices pull back into your POI, you have 2 options. You can either enter off the current time frame or drop to the lower time frame. If you drop to the lower time frame, you can either repeat the process again, but use the current time frame's key level, because again, price is fractal, okay? So what you see on high time frame is sometimes what you see repeated on the lower time frame. Or if you're using the current time frame to enter off, then just simply enter off an imposing engulfing candle closure. Once you have entered the position, price should, majority of the time, head to your key level, or you can manually manage it with structure. And that is how you trade the sweep and shift entry model. Now, I quickly want to mention Admiral Markets because you've probably seen their logo on the bottom left of the screen, but they are a UK-based broker since 2012, which are also regulated, and they offer over 8,000 financial instruments that you can trade across 6 asset classes as well, along with a minimum deposit of £250 or €250, with a leverage up to 1:30, which is your standard retail. And they also offer many trading tools, for example, like Stereo Trader, Premium Analytics software, in which on my previous videos you would have seen. So guys, make sure you go ahead and check them out. The link will be below in the description. So hopefully you can see my mouse here now. We're on the live market charts. I just quickly want to go over some examples from what I've been explaining. So again, just follow my mouse because I'm listening along really. So range high and low, pretty obvious, right? Key level is for price to obviously, take out the low here and continue bullish and take out the high there. So that's the key level in which I want to target into. Now, you can previously look at the previous structure and overall external structure on the higher time frame and say, okay, my price has been bullish, so obviously you better would work. For example, if you are having a bullish bias or anticipating higher prices on the higher time frame, for example, okay, you can anticipate a sweep of the lows to continue with the overall highs again, targeting to the highs, okay. Now, range high, range low. Key level, because obviously that's the level I want to see price target into. Liquidity, as you can see here, is because we had this equal lows created, and all this is internal structure. Price had wicked out this previous range low and also swept out the liquidity there, and then obviously shifted bullish to the upside, which is obviously, at this point we're thinking, okay, well, price has reacted for a reason, okay, so we can look to trade from the area. And also you can look to the left here, it's manually filled and imbalance, which we can discuss in a later video. But as you can see, we also took out some structure here to the left. Yes, this is an internal structure, but it's still valid. But as you can see, this is a previous lower high in this bearish internal structure. And then price has shifted to the upside, also taking out some previous other highs as well. So not only got one break, but we've got multiple breaks above previous lower highs. Now, as you can see here, we've got to pull back into the POI. Now, again, at this point, you can drop to a lower time frame and look for your opportunities and still keep with the current on this time frame. This is the 50-minute on EU, and you can still keep with this key level on the high time frame, but you just use the 1 minute on target into the 15-minute key level, okay? Or you can stay on the same time frame and have a limit order there, or wait for candle closure. Like for example, a bullish candle, like for example, you can enter off this one here. So it's completely up to you. There's many different ways you can approach this, but for me personally, I dropped to lower time frame. Moving on to another example here. Again, we got a liquidity, we got a key level, okay. Price moving bearish. We had this huge range bound market, price just creating equal lows, so there's definitely some support area there which price would be looking to, well, it's not price, sorry, but many traders would be looking to buy from, so to speak, okay. Price obviously took out those lows, then we had a nice impulsive shift to the upside there, taking out some previous lower highs there in the market, and then we pull back into the POI. Now, if the shift initially wasn't enough, you can wait for the breaker structure, okay, which is to confirm the trend. And you can also take this as a mitigation as well, but this is also more so known as a internal POI mitigation, okay. Now, you can learn more of this concept, stuff like that inside of my mentorship. I will go over that at the end of the video. And again, as you can see here, price shifts to the upside again, also breaking structure, which really confirms the bullish trend now, potentially, that we are in a potential trend reversal, so to speak. Now again, if you look at high time frame things like that, like I do, like for example, I look at H4, then drop down to the 15-minute, I may have a H4 POI marked up somewhere along here, which also aligns with this. So just as you can see, as you can tell already from what I'm saying, it's starting to add high probability setups to your, to your trades, right? It's a high probability setup once you align up all these factors and, come up with multiple things, so to speak, right? And then again, after the break structure, price pulls back into another newly formed POI and then shifts bullish from there, targeting into the key level. Moving on to another example, I'll try and speed up the process a little bit here because you guys kind of get the idea from this point. I will give you a little bit of homework to maybe go and do at the end of the video. We'll see what time we're on, but let's just keep going. So as you can see, key level here we want to target into. Now this would more so be the key level over here on the high time frame, but I just marked this one for now because obviously once price reaches that level, we have a new key level to trade from. Okay, as you can see here, big range here, many lows being created here. Liquidity, nice shift to the downside and then shift to the upside here. Now you can argue that you could have got an entry there and dropped to lower time frame off this imbalance fill, or also known as a fair value gap fill to those traders who trade that way. But to us, I mean, there's a better entry later on, so to speak, okay? And this isn't the highest probability setup according to our ZCFX rules, but it's still valid. It's just more so medium to lower probability, so to speak, okay? Then we break structure again, confirming the bullish trend reversal. We then create this new high and range low. Price pulls back into that POI there, clear order block, and price mitigates that and moves bullish again. And then we then take out this high, and we have a new range high, new range low, because the previous key level was invalidated, even though this is the overall key level, looking to the left of it. But this is the key level that we want to target into with inside of this range. Price pulls back into this POI, wicks out this low here, and obviously taps into this POI again. Because obviously this previously wasn't validated. This is only validated here because this is where price had obviously broken the structure. So even though we mitigated it before, I'm expecting the price to come down and mitigate something else, again, and potentially wick out the low there. It's a little bit more complicated to understand, or advanced, sorry, is a better word, not complicated, to understand this bit of concept that I'm trying to explain, but that's something I'm discussing in my mentorship, so make sure you go ahead and check that out, guys. But again, POI mitigation and just price goes on and continues to take out the high. That's another example there. Two examples in one here, guys. We've got a bullish and a bearish scenario. Okay, key level, liquidity sweep, wicks to the downside here. We've got a shifted upside here. Look at that. Look, when you look at the impulsive shifts, look at the momentum inside of the move, right? Look at how big the candles are. Like, this is a very big candle invalidating all these previous candles here. Okay, which obviously is a sign of increased volatility in the market, or more volume being pushed into the market. Okay, and we get that shift to the upside there. We then pull back into this clear breaker here. This is a clear as day breaker, and then obviously the next thing to do would be, in my opinion, to drop to a lower time frame, which is that's what I do. Or you can just set limit order off, obviously after we close there, off there, a buy limit order with your stops below the overall low and target into the key level. Anyways, moving on, price just obviously follows structure there, pretty much break structure. We then get a pullback, but we don't get any reaction off this previous, what would have been a potential POI, but the previous key level was already reached anyway, so that well, if we were looking for buys, we probably would no longer look for buys because that was the previous key level in which we wanted to trade from. But anyways, price didn't react either way. We then shifted to the downside here with a nice closure there, forming a new range low and high. All this is internal structure, but as you can see here, we create equal highs. Okay, so there's liquidity there and also the range high. Price spikes up there with a wick. Obviously, this can be also deemed as a huge wick rejection, so a wick rejection to the upside there. And then we get a shift to the downside here, internal shift, still valid. And then we create more equal lows, if anything, and then we pull back into the POI there, and then go on and hit out the key level and mitigate something in here and continue bullish. But yeah, as you can see, that's how the sort of overall framework sort of works. But guys, as I mentioned earlier, I want to quickly go over some potential homework for you guys. So what I would recommend to do is just jump on the 15-minute time frame, pull up your USD. It applies to pretty much any chart, anything that has clear candles for you to trade off. It just involves pure price action, looking at the market conditions and reacting based on the impulsive shifts. See, the key word there was reacting off the impulsive shifts. That is the key word. When you see that impulsive shift, it could be a sign of potentially something happening in the market. So don't be afraid to look into it and react based on and adapt to the potential what price is about to do. But yeah, just pay attention to the key levels and liquidity sweeps and make sure you are marking up the shifts. And yes, it may be an impulsive shift, but impulsive move, but did it take out any highs or lows? So go ahead and mark up those on the charts and see what you think and have a little play around with it. And yeah, you can start to, you know, look at the lower time frame. Maybe I can go into a part 2 where I show you the lower time frames off these charts here, and show you some more live examples. But yeah, this is just a simple concept that you can get some nice, you know, trades for. I mean, at the end of the day, this is all EU 15-minute time frame, and it's all within the same few weeks period. And there's 2 opportunities there. There's one here, one here, one here. All you need to do is, that's what, 3, 5. That's 5 opportunities minimum there, and that's within 2 to 3 weeks. And with those opportunities becomes many scaling opportunities that you then can start to focus on later on down in your career. Like, for example, stacking your winners and cutting your losses. That will also massively increase the, you know, the win rate and things like that, and increase how much money you're making. But yeah, that's all. Just jump into another video. But go ahead and just have a play around on your, you know, FX replay or trading view, and just, even if you don't want to back test it just yet, just look at the past data. You don't even need to use the bar replay mode. Just sort of train and condition your eyes to see it, and then start to back test it. But guys, that's pretty much how you trade the sweep and shift entry model. I hope this video has brought you much value. But quickly want to mention my course here. So there are going to be some new content during 2025. And obviously we're going to be increasing the price at some point too, as value increases. We're also hosting 2 weekly live calls, but that's looking to change maybe into more. We're also looking to adding monthly webinars. We're bringing on some coaches as well. So guys, make sure you get involved now in the academy, because the price are only going to increase. The value's getting more added. You know, I've been trading for 8 years, 9 years going on into 2025. So there's a lot of you know, knowledge in the course, and the way I speak about trading so fluently. You know, there's a lot of things to pick up from, especially in the live calls. Also, a lot of students have mentioned how valuable the live calls are. So guys, I would really recommend, and highly recommend, sorry, joining the mentorship. But yeah, go ahead and check it out. All links will be below, and to Admiral Markets as well. Go ahead and check out that broker too, guys. Take care.